Hello and welcome to today's Your Daily Five. I'm Tom Bowley, Chief Market Strategist at earningsbeats.com, and I'm happy to join you on this Wednesday, April 12th. Taking a look at today's Your Daily Five, I'm going to get into some seasonality, but before I do, I just want to mention to everyone, we do have a huge event coming up this Saturday. It's free, open to the public. Everyone's welcome. It will be held on Saturday, April 15th, this Saturday, 10 a.m. Eastern. You do need to register. I'll be providing my forecast for the balance of the quarter and for the rest of the year. I did a market vision event back at the beginning of the year. I think my forecast so far has kind of played out as expected. Where do I see it going from here? Well, you need to join us on Saturday, 4:15. That's April 15th, 10 a.m. Make sure you click on that button to register now. So go over to earningsbeats.com, both plural, earningsbeats.com. And make sure you register. Love to see you on Saturday. All right. For today, what I want to do is talk a little bit about go away in May. So I'm going to give you 5 seasonality charts today, which is a little different. Usually I'm giving you price charts, relative strength, absolute price charts, whatever. But today I'm going to focus on seasonality. But I just want you to look. This is a longer term. I think this is a 35-year chart of the S&P 500. And the period I'm going to concentrate on for seasonality is going to be since 2013. And the reason I'm picking that time frame, you can see the double top on the S&P 500 from 2000 and 2007. We actually confirmed the start of this bull market, secular bull market, back in 2013 when we broke out in April of 2013. It was actually 10 years and 2 days ago that we broke out. I'm pretty sure it was April 10th of 2013. And so since that time, we've been in it's hard to argue, a secular bull market. We've had a huge run up, had some cyclical bear markets along the way. We had the 2018 trade war issue. We had 2020 pandemic. And then, of course, 2022 with inflation, interest rates moving up and so forth. And of course, that came on the heels of a huge run in 2020 and 2021. So we gave back some of that. But overall, the trend clearly, to me, is to the upside. So as I go through today, I want to focus on seasonality, and in particular, this whole notion of go away in May. You know, there are a lot of folks, you're going to hear it. It's, we're getting close to the middle part of April. You're going to start to hear about go away in May. And the fact that, we've got potential of a recession and we've got the Fed doing this and that, and there's still inflation. Hey, tuck your money away. Forget about it. You don't want to be in the market. That's what you're going to hear. And I'm here to tell you it's a lot of hogwash. Now, October to April has proven over time to be better than May through September. Or actually November through April versus May through October. Those two time frames, clearly we have more strength from November to April. So I'm not trying to argue with anyone about which period is better. Okay, from that standpoint, there's no doubt that November to April has historically performed better than May to October. I give that much to the go away in May folks. But that doesn't mean you don't want to be in the stock market. So let's take a look at 5 seasonality charts. First one I'm going to start with is simply the S&P 500. And I'm going back 11 years on this slider so that we are showing the 2013 to 2023 period, which is essentially this secular bull market run. Now, if you go back further than that, you'll find that most of these trends I show you will hold up even in prior years. But I'm just focusing on this secular bull market run. Look at the S&P 500. So we're looking at May, June, July, and August, right? Well, if you look at, first of all, for the year, if you add up the average monthly gain for each one of the calendar months on the S&P 500 for the last 10 and a half years, what you're going to find is that the S&P 500 averages going up 11.5%. Now we're talking about 4 months. I want to point out May, June, July, and August, because I think these 4 months tend to be better, especially May, June, and July. But let's just add the 4 months in. This is 1/3 of the year, right? If you take May, June, July, and August and add these up, you come up with 4.5%. Now, 4.5% is almost 40% of the total of the 11.5 for the year. But we've only got 33% of the months. So these 33% of the months are producing 40%, roughly 40% of the S&P 500 return. Why would you want to go away? It's actually outperforming the average throughout the year. And look, as we go up, look at how many times the S&P 500 has closed higher over these last 11 years. May, 90%, 9 out of 10. The reason it's not 11th year is because we haven't had May of 2023 yet. 90% of Mays go higher. 90% of Julys go higher. 70% of Junes go higher. Where are you going when you go away in May? So that's the S&P 500. Now let me move on. And I like to look at relative ratios. I like to look intermarket to see what the more aggressive areas do relative to the more defensive areas. Now, the SPDR is not necessarily defensive. It's just a little bit more value-oriented than the QQQ, which is a little bit more aggressive. So looking at the relative performance, I think tells us quite a bit about the market too. Because if you're thinking cautious, wouldn't you think value, defense would lead aggression and offense? Normally, you would think that. So let's look at the QQQ relative to the SPDR. So when you look at these percentages down at the bottom, this is saying that in January, over the last 11 years, the QQQ is averaged outperforming the SPDR by 1%. That's January. And the QQQ has outperformed 73% of January's. All right. Now, again, taking the same approach and looking across here, we've got the total QQQ versus SPDR. Total for the year has been 4.8%. So the QQQ is averaged outperforming the SPDR by 4.8%. Add up May through August, because if you do that, it's 4.1%. 85% of the outperformance of the QQQ relative to the SPDR comes during the months May, June, July, and August. So maybe you might want to go away from the S&P 500, but according to the seasonality chart, if you do, you want to go into the QQQ. You don't want to leave the market. You don't want to go away. I think a lot of times you get the media that talks about go away in May and people think, oh, market's going to collapse. There's little in the way of history that supports that claim. You might want to go into some other areas of the market, but you don't want to leave the market historically from May through, I'm going to say mid-July, but even into August in some cases, like with the QQQ. Next up, small caps. I'm just looking at the IWM, no relative chart, the absolute strength of the small caps. For the year, small caps average going up 10.6%. During May, June, July, and August, 4.6%. That's 43% of the return on the IWM is generated during 33% of the months right here. So again, go away. I don't know, maybe just reposition in small caps. How about large cap growth versus large cap value? IWF versus IWD, kind of the same principle as the QQQ versus the SPDR. What is that telling us? Well, again, if you add up across for the year, the IWF IWD goes up 4.5%, outperforms on average by 4.5% per year. Do you want to know what it outperforms from May through August? 4.8%. All of the outperformance of large cap growth versus value takes place from May to August. That's pretty stunning. Again, IWF versus IWD goes up on average 4.5% a year. Growth outperforms value, large cap arena, by about 4.5% over the last 11 years. And it outperforms by 4.8% just in these 4 months. Again, do you want to go away from large cap growth? I don't think so. Last one I have for you. This is the XLY XLP, consumer discretionary versus consumer staples. You look across all of the months, and the average has been 2.9%. If you average all of these across, you get 2.9% average annual outperformance of the consumer discretionary group relative to consumer staples. 2.9%. Add up these 4 months, May, June, July, and August. What do you get? 2.8%. Again, almost all of the relative strength for the last 11 years of consumer discretionary versus staples occurs during the months May, June, July, and August. So looking at seasonality, we didn't really look at any charts in this session, so it's a little different. I love the seasonality tool at StockCharts, mostly because I'm a historian, and I love to go back and find historical tendencies in the market. And I think what these 5 seasonal charts tell us is that maybe going away in May isn't such a great idea. The QQQ outperforms the S&P 500. Consumer discretionary outperforms consumer staples. The small cap stocks, these are 4 of the best months coming up for small cap. And IWF, large cap growth, versus IWD, large cap value. The entire amount of relative strength that ratio has seen in the last 11 years can be found from May to August. So when you think about going away in May and you hear all these headlines or see all these headlines and hear all the talking heads on the media, it rhymes. It sounds great. It sounds pretty cool. Go away in May. I'm going to say maybe it's more like fly in July or something. Going through here, you see a little bit of carryover strength into August, but really May, June, and July tend to be pretty good months. And for technology, even August tends to be a pretty good month. So keep all these things in mind when you make your decisions, and just don't blindly follow the media and what you're hearing there. All right, that's it for me. Time's up. I do want to thank everybody. It was certainly a pleasure joining you today on Your Daily 5. Please remember to go over to earningsbeats.com and sign up for our free Bullseye Forecast event. It's this Saturday, April 15th at 10 a.m. Eastern. It is completely free and open to everyone. We really want to try and give back to our community. Please take advantage and join us this Saturday. You might not agree with much of what I say. You might not agree with any of it. You might agree with all of it. It doesn't matter. I'm going to give you actual, factual information, and then you can make your own decisions about what you think as we go into May and beyond. Listen, everyone have a great day. Happy trading.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.